It didn't start with a crisis. It started with silence, quiet purchases, hidden shipments, vaults filling faster than at any time in modern history. In 3 years, the world's central banks bought 3,000 tons of gold, the most since records began. Not retail investors, not billionaires, governments. And when institutions that plan decades ahead start moving this fast, they're not chasing trends. They're bracing for a different future. Picture this. It's a Tuesday morning in Shanghai. Inside a fortress-like building surrounded by armed guards, workers in white gloves carefully stack gleaming gold bars, each one worth more than most people earn in a decade. The bars disappear into reinforced vaults buried deep underground. This scene isn't from a heist movie, it's happening right now at the People's Bank of China. And they're not alone. Across the globe, from Moscow to Mumbai, from Ankara to Warsaw, central bankers are quietly orchestrating the largest peacetime accumulation of gold in modern history. In just 3 years, from 2022 to 2024, the world's central banks purchased over 3,000 tons of gold. That's more than twice their historical average. But here's what should make you pause. These aren't random purchases by nervous politicians. These are calculated moves by the smartest financial minds on the planet, people who have access to information you and I will never see. This is empire economics, where history and money collide. And what's happening right now with gold isn't just a financial story. It's a signal A warning written in the oldest language of money that something fundamental is shifting beneath our feet. To understand why central banks are suddenly accumulating gold as if it's the most reliable anchor in an increasingly uncertain financial sea, we need to go back to a moment that changed everything. February 24th, 2022. Russian tanks rolled across the Ukrainian border. Within hours, something unprecedented happened in the world of international finance. The United States and its allies didn't just impose sanctions on Russia. They froze $322 billion of Russian foreign reserves. Money that Moscow had carefully stored in Western banks and securities, accumulated over decades, vanished with the stroke of a pen. For central bankers around the world, this wasn't just about Russia. It was a revelation. If the world's 11th largest economy could have its reserves frozen overnight, what did that mean for everyone else? The dollar, which had seemed like the ultimate safe harbor for nearly 80 years, suddenly appeared less neutral and more influenced by geopolitical decision-making. But the smart money had already seen this coming. Russia itself had been quietly preparing for this exact scenario since 2014, when the first round of sanctions hit after the annexation of Crimea. While the world focused on geopolitics, Russian central bankers were making a different kind of calculation. They began converting their dollar reserves into something no Western government could freeze: gold. By the time tanks crossed into Ukraine, Russia held 75 million ounces of gold, worth over $200 billion. It represented 35% of their total reserves. When the sanctions hammer fell, that gold became their financial lifeline. The same metal that had anchored empires for thousands of years was once again proving its worth as a historically reliable form of monetary insurance China was watching. And China was learning. The People's Bank of China officially reported buying 44 tons of gold in 2024 alone. But that's just what they're telling us. Intelligence analysts believe the real figure is significantly higher. China's official gold reserves still represent only 5% of their massive $3 trillion reserve portfolio. For a nation that thinks in centuries, not election cycles, that leaves enormous room for further accumulation. But China isn't just buying gold. They're building an entirely new infrastructure around it. Reports have emerged that the People's Bank of China is offering to store other countries' newly purchased gold reserves. Think about that for a moment. China is positioning itself as an alternative to the traditional gold storage centers in London and New York. They're not just preparing for a world where the dollar matters less. They're actively building that world. The numbers tell a story that should make anyone holding dollars stop and think. Central banks purchased over 1,000 tons of gold in each of the last 3 years. That's more gold than some countries have accumulated in decades. And it's not just the usual suspects. 23 different countries increased their gold holdings in the first half of 2024, from Turkey to Poland, from India to Kazakhstan. Nations are quietly diversifying away from dollar-denominated assets. This isn't happening in a vacuum. The dollar's share of global foreign exchange reserves has fallen to just under 60%, a 2-decade low. While this isn't unprecedented historically, what makes it different this time is the reason behind the decline. This isn't a cyclical economic shift. It's a strategic repositioning driven by a growing understanding that financial systems, like empires, are more fragile than they appear. The acceleration began in 2022, when central bank gold purchases jumped 140% year over year. That wasn't coincidence. That was the moment when theoretical risks became real, when the unthinkable became policy, when nations realized that holding someone else's money meant playing by someone else's rules. Turkey provides a perfect example of this new thinking. Under pressure from both inflation at home and geopolitical tensions abroad, Turkey's central bank has been steadily increasing its gold reserves. They've learned what Russia learned, what China has always known. Gold doesn't care about your politics. It doesn't freeze your accounts. It doesn't sanction your trade. It simply sits there, storing value across time and conflict, as it has for 5,000 years. But this shift runs deeper than geopolitics. It's about mathematics. The United States debt-to-GDP ratio has climbed from 35% in 1970 to 124% today. The Congressional Budget Office projects it will exceed 155% by 2055. For central bankers managing reserves for the next generation, those numbers don't inspire confidence. They inspire diversification. Every empire in history has faced this moment. Rome debased its silver coins until they were worthless tin. Spain flooded the world with New World gold until it destroyed its own currency. Britain watched the pound sterling lose its reserve status after 2 world wars bankrupted the empire. The patterns don't repeat, but they rhyme, and central bankers around the world are hearing that rhyme getting louder. What we're witnessing isn't just about gold. It's about a gradual shift in the foundations of the global monetary order. For decades, the world operated on the assumption that the dollar was forever, that American financial dominance was permanent, that holding treasury bonds was the same as holding money itself. But assumptions, like empires, have expiration dates. The central bankers buying gold today aren't betting against America. They're betting on mathematics, on history, on the understanding that no monetary system lasts forever, and the smart money prepares for what comes next before everyone else realizes the game has changed. What makes this accumulation different from every other gold rush in history isn't just the scale, it's the silence. There are no newspaper headlines screaming about central bank gold purchases, no breathless television reports tracking every ounce. One of the most significant monetary reallocations in decades is unfolding, yet most people have no idea it's occurring. That's because this isn't your grandfather's gold rush. This is institutional chess played at the highest levels of global finance. While retail investors debate cryptocurrency and meme stocks, the world's most sophisticated financial institutions are quietly returning to the oldest store of value known to humanity. They're not buying gold because they're nostalgic. They're buying it because long-term risk management demands it. Consider the mathematics of what's happening. Nearly 1/5 of all the gold ever mined in human history is now held by central banks. Think about that number for a moment. Across 5,000 years of civilization, through Egyptian pharaohs and Roman emperors, Spanish conquistadors, and California 49ers, humanity has pulled roughly 200,000 tons of gold from the earth. And central banks now control 40,000 tons of it. This concentration represents something unprecedented. Never before in peacetime have monetary authorities held such a massive percentage of the world's gold supply, not during the classical gold standard, not during Bretton Woods, not even during the height of American financial dominance in the 1950s and 60s. What we're witnessing is the systematic preparation for a monetary system that doesn't yet exist. The mechanics of this accumulation reveal just how coordinated the effort has become. Traditional gold markets operated through London and New York, with transactions cleared through Western financial institutions. But that's changing rapidly. Alternative trading networks are emerging, designed specifically to bypass traditional Western control points. Russian gold now flows through Hong Kong and Shanghai rather than London. Chinese companies are accepting gold payments directly, depositing the proceeds in Asian banks to pay suppliers without ever touching dollars. Turkish gold refineries are processing metal from mines across Central Asia, creating supply chains that exist entirely outside Western oversight. These aren't random market developments. They're the construction of alternative financial pathways. The implications become clearer when you examine the timeline. The first major acceleration in central bank gold purchases began in 2010, just 2 years after the global financial crisis revealed the fragility of Western banking systems. But the real inflection point came in 2014 with the first round of sanctions against Russia. That's when gold purchases by emerging market central banks doubled, then tripled, then became the new normal. By 2022, when Russian reserves were frozen, the pattern was already established. The sanctions didn't create the trend toward gold, they validated it. Every central banker who had been quietly accumulating gold over the previous decade was suddenly vindicated. Every government that had trusted entirely in dollar reserves was left questioning that strategy. India provides a fascinating case study in this transformation. Traditionally, Indian gold demand came from consumers, families, and temples. But since 2022, the Reserve Bank of India has become one of the world's largest official gold purchasers. They're not buying gold to satisfy cultural preferences. They're buying it as monetary insurance against a world where financial assets can be influenced by geopolitical actions. The same pattern appears across dozens of countries. Poland, which holds minimal historical gold reserves, has been aggressively accumulating since 2021. Hungary repatriated its gold from London storage back to Budapest. Even Singapore, traditionally focused on foreign exchange management, has been steadily increasing its gold allocation. The message is written in the metal itself: 3,000 tons of gold, accumulated in just 3 years, representing the largest peacetime monetary shift in modern history. Central banks aren't hoarding gold because they've lost faith in the future, they're preparing for it. History shows us that those who understand money's true nature survive its transformations. The question isn't whether change is coming. The question is whether you'll recognize it when it arrives. This content is for educational purposes only and does not constitute financial, legal, or investment advice. If you enjoy learning how history and money intertwine, subscribe to Empire Economics for more untold stories.